Tunde Adama, the head of trading at Citi Nigeria, joins me now from Lagos for a focus on the fixed income and FX markets today. Thank you so much for joining me, Tunde. And I'll first like to start up with the bond auction we saw yesterday. What played out?
Yeah, hi, Ken. Yesterday, central bank, the DMO put up 20 billion each for 2023, 2035, and 2050 bond auctions. And the demand was quite heavy as expected. And they ended up selling about 67, 68, and about 160 billion each. So instead of 60 billion that was put on offer, they ended up selling about 295 billion. The rates came out at 9.2 for the 2023 maturity, 11.7 for the 2035 maturity, and 0.6 for the 2015 maturity. So it was quite a strong auction.
All right, but I'd also like to look at the CBS intervention so far. I understand there were some OMO maturities today, and I don't know if there was an OMO auction.
No, there wasn't today. I guess part of the reason is this almost 300 billion will be leaving the system tomorrow. And tomorrow also will be the central bank retail SMIs auction. So combined, we could see quite a lot of liquidity between 450 and 500 billion in additional liquidity in the system. So for that, CBN might have decided there was no reason to have an OMO auction today.
All right, but still looking at this liquidity situation, though, I'd like to know what your thoughts are and how it's going to play out going into the rest of the week and even next week as well.
Rates, the money market liquidity has been quite adequate with money market rates at low levels, single-digit levels. We expect that, like I mentioned, all the liquidity leaving the system. In the fixed income market, we've seen yields sort of adjust to the huge sales yesterday. So for bonds, we've seen adjustment of about 10 to 15 basis points around the maturities that central bank issued yesterday. And even T-bills, which had been very big in the market, with a lot of people having liquidity and buying across tenors. We saw some adjustment today of, on average, about 30, 40 basis points across the curve. Suggesting the huge sales yesterday. People expect that we have a bit less liquidity going to the long holiday. So it's not going to be extremely tight, but there will be a bit less money market liquidity in the system going to the long holidays.
All right, but looking at the rally we're seeing so far with oil prices, though, how do you think this will trickle in into how investors play in the fixed income and FX market?
It's positive for Nigeria because it does mean that the accretion to the reserves would be a lot better than we saw, definitely when we were at $20 per barrel. But we are still a long way off from where we thought the average rate to be at the beginning of the year, for example. So it will still be a big challenge, but it's a move in the right direction. And there's a hope that as all the global economies start to reopen gradually, possibly with international demand, general demand going up in the market, that we could see the average crude oil prices go up as we get into Q2, Q3, Q4. I think it's at that time when we have some stability and oil prices at a higher level that possibly start talking about being at levels that we start to see a much larger accretion. So for now, it's positive, but still much lower than we'd like it to be.